Let's keep our seat belts fastened. We are still flying over Asia. We'll be receiving two very experienced professionals here to talk us about Asia and reflecting about the costs of investing in that continent, if it's worthwhile to do it. The first one is Vidak Radonjic. Vidak is the founder and CEO of Beryl Consulting Group. He has over 15 years of experience. He's responsible for every aspect of the firm's hedge fund advisory services. He has a very impressive CV with a master's, an MBA in corporate finance from Pace University, and a master's in international affairs, from Columbia University. Our other guest is John Tsui. He's managing principal of the Peninsula House, LLC. It's a cross-border alternative investment company involved in structured direct investment and real estate assets. He also has a very impressive CV with masters in real estate from Columbia. He earned an owner-president management degree at the Harvard Business School, and he's a professor at Columbia University. So welcome our guests and speakers, and good luck.
Thank you very much. So welcome everybody. We're going to go through slides because I would like to show you some charts, so it might be easier. So the topic is alternative investing across Asia, and do the costs justify results? Let's talk first quickly from top down. Asia long-term structural situations, which in our opinion is quite positive. As this previous speaker, Kumal Mehra, mentioned, there is a very young population in Asia, so demographics are extremely in favor, speaking about these long-term structural positives. Then we have urbanization, the rise of new middle class, and the resulting increase in domestic consumption. So this is coupled with significant infrastructure investments. So these are all, again, long-term positives. If you look at China, for example, urban population as percentage of total population in 1978 was 70%, and it's been projected to be as much as 50% in 5 years. Indonesia, similar, 70%. It's projected to be even higher, to 60%. If you're looking again in population per capita GDP over US $5,000, we have a huge numbers here. 2010, the number is 271 million. And in about 8 years, we're going to reach almost 900 million only in China. Indonesia is 77 million. So it's amazing. It's amazing growth potential. We're living in two-speed world. I think you heard that from many various speakers during this conference. Advanced economies are over-leveraged and experience anemic growth, and on the other hand, emerging economies are growing rapidly, but again, with a very high cost of inflation. So both public debt as a percentage of GDP and fiscal balances are much better shaped in Asia and Brazil than in advanced economies. So what's the case for hedged approach in Asia? Why should people use hedge funds? Well, anomalies are there, dispersion of returns are there in the Asian markets, which suggests that there are some great opportunities across various hedge fund strategies. And we will talk about hedge fund strategies in the subsequent slides. So since 1990, MSCI Asia, for example, has 4 corrections of 50%. So that's the last 20 years we had corrections of more than 50%. That's a huge that's a huge percentage. And in order to break even, you have to obviously make more than 100%. Obviously, having a hedged approach makes lots of sense because hedge funds can go long and short. How should investor participate in Asian growth? Where, as I suggested in our earlier slide, it should be really through hedge funds, because you don't want to hold it back and wait 3-4 years to recoup your money, or maybe even longer. Asian hedge funds are also fantastic for, I'm using the word fantastic, I don't know why I'm using this word. Asian managers are really good for expanding efficient frontier curve. As this slide suggests, if you add some Asian hedge fund managers into your mix of other hedge funds, as well as mix of other equities or fixed income traditional assets, you can greatly enhance efficient frontier curve. Here you have another chart. We have actually, we at Beryl Consulting, we have a software that we develop in-house, so we're a very quantitative shop as well as qualitative shop, and we take pride in looking at different portfolio, customized portfolios, and we try to really pay attention to the statistics as well. Our funnel hedge fund model portfolio follows a core and satellite investment approach, and that's the case in any region, be it Latin America, be it Asia, or be it United States. So the core bucket consists of well-established funds, blue chip funds, and then we have satellite buckets of niche and emerging managers. Our managers on the ground, they're investing in companies that can participate in this growth. Demographics that we just discussed in the earlier panel, rising disposable income, Middle East, the rise of middle class, and development of infrastructure. So now, just to give you an example how the trend in terms of size of hedge fund universe. In 2000, beginning of 2000, we had less than 150 hedge fund Asia hedge funds focused managers with about $20 billion in AUM. Then in the span of only 7 years, we reached $175 billion. So that's more than 600% increase in AUM. And in terms of number of funds, the highest number was about 1,300. And then we have this crisis in 2008. Lots of funds lost their shirts, and the AUM has dramatically reduced to below 100. I think it reached 80 billion at its low point. Now we're back to 130 billion, and it's projected that we will come back to 180 in about 6 to 12 months. In terms of performance, it's important to look at the chart. I mean, performance has been really outstanding. Whoever has invested in a hedge fund index of Asian funds has done really, really well. Over the last 4 years, Asian hedge funds outperform most hedge fund indices and equity indices as well. And since January 2000, the Asian hedge fund index is up 178% against MSCI Asia, which is down 9%. Also, volatility is another thing that everybody worries, and we can look at this chart. It seems like hedge funds, again, are doing a very, very good job. Average annualized standard deviation of Asian hedge fund index is 7.6%, against 16.3% for Asian equities. Again, we're looking at the same time period since December of 2000, 10 years. Evolution of strategies, as I said earlier, early 2000, most Asian hedge funds, if you went to Hong Kong, Singapore, you will be just spoken to mutual funds, long-short equity guys, and some long-short, long-only guys, and some long-short equity guys. But nowadays, managers have the opportunity to invest in a wide area of hedge fund strategies. So the menu has increased. And therefore, the evolution has been very helpful for building a successful fund of hedge funds. I also would like to mention that there is a third generation hedge funds coming out of proprietary desks of big banks, as well as largest hedge funds in Asia. They have spin-offs. So the new managers that are setting up shops in Asia are very well qualified. They have decent track records, and they're very they're well aware that infrastructure is very important. Now, today in Asia, as I said, we don't have an only and long short. We have arbitrage, CTA, distressed, event-driven, fixed income, long short, macro, multi-strategy, and relative value. So we came a long way. In Latin America, Brazil specifically, we have a long short, long only, multi-strategy, fixed income, but we still don't have other strategies yet. How do we actually construct portfolios? I'll just go very, very quickly through these charts. We, as a group at Beryl Consulting, we get about 2,000 managers reporting to us on a monthly basis, of which 400 plus are from Asia, and we go to Asia very often to actually see the managers. And we have a proprietary tool to actually scan these managers quickly through our software that we developed. So today we have 1,300 managers. That is up 500 from 2 years ago. Again, there's a lot of managers coming out. We obviously are very cognizant that all these 1,300 managers we have to scan. And we're not going to meet all of them, but we will meet maybe 200 or so, which we did. And our objective is to come up with 15 to 20 great managers. Aspects of manager evaluation, I will rather skip this. Obviously, we had people here speaking about due diligence before, but for us, the most important four quadrants is independent thinking, investment execution, risk control, investment edge. That's what we're looking for, and then we go and slice and dice and learn more about the details. When you're constructing a hedge fund portfolio in Asia, you have to be very careful where you are in the cycle. So right now we're in the trading markets. So alpha guys, we will focus on those guys the most, and those directional guys that we focused in early stage of bull market 2 years ago. We will be very careful with those guys. And our research is driven by a global macro and bottom-up manager search. When you construct portfolio, you have to be very cognizant of correlations. So if we see any red flags, then we need to be quick and adjust and find new managers. Portfolio construction, we do top-down optimization, bottom-up optimization. The same thing in Asia, same thing in Latin America, same thing in US. The reason is we want to make sure that we allocate the proper amount of money to managers and not just give them equal amount. We want to be able to smooth this volatility, utilizing these optimizers, so increase Sharpe ratio, increase alpha, reduce volatility, reduce VAR. And I think this is the most important slide of the presentation. 6 quadrants. What are the success factors in Asia? It's alpha generation, it's infrastructure, it's finding nimble managers, portfolio manager experience, local expertise, and accessibility of managers.